the debt to GDP we're facing is like 140%. We said without the unfunded liabilities.
It's about 125% without, on a gross basis. Yeah.
Okay. Where does that put us? I mean, if we're going to use the baseball analogy of what inning we're in, which so many people like to use. And I know you said you didn't think US dollar hyperinflation was likely given the extensive reserves that we have. But what I guess maybe abstracting away from the United States specific example, what does 125% debt to GDP look like in terms of baseball innings for where you are on the path to hyperinflation for your typical country historically?
For an emerging market, and the other thing too is we're twin deficit, right? By virtue of we have the reserve currency, we have to be twin deficit. But if 125% twin deficit, that was Argentina, 2002.
Mm-hmm. Could you expand on that too? Twin deficit.
Yeah, twin deficit is trade deficit and fiscal deficit together.
Oh, okay.
Yeah,
gotcha.
Yeah, so you're running both. Yeah,
is this related to Triffin's paradox?
Sort of tangentially. It's basically, it's a current account, your country's current account, right? Mm-hmm. So you basically, if you have a twin deficit, you're not earning, if you have a surplus, fiscal or a current account surplus, you're actually earning money, right? So like Japan,
importing more than you're exporting.
Right,
or,
exactly.
I'm sorry, exporting more than you're importing.
Correct. Yeah. Yes. So your net you're in the black in terms of your net flows on an annualized basis, which makes it easier to service your debt.
Right.
That's why that's important, because if you're a twin deficit nation and you have the 125%, normally, you need to refinance what you have and you're borrowing more and your rates are going up and it's very bad. And so historically, twin deficit nation, 120%, like you're dead. You're going to have a debt spiral. You're going to have a currency crisis. It hasn't happened to the U.S. because we have the reserve currency. And broader, that tells you you're very late innings, right? You're very late innings. Specific to the U.S., I think it's very late innings too, because, and again, not necessarily towards hyperinflation, but towards significant inflation and currency depreciation against sort of that physical world, right? That stuff. Because of those obligations, which are entitlements, interest, which are just, the current portion of both, last 4 months, they're running at 103% of receipts. Mm-hmm. And so historically, a number of different graybeards tell me this. Historically, once you have to print the VIG, once you have to print the interest, you're done.
Moneyball the interest.
You're done.
I've heard this too.
And so
makes sense, by the way.
It makes perfect sense, right?
Because you're talking about just the amount of money necessary to service the existing debt accumulation. You can't even afford that. So like the rough analogy might be something like if you had a $100,000 income and you had, $120,000 worth of credit card interest payments every year.
You're done.
Right, you're done.
You're done.
Like, you're not going to make that.
It's over. So last 4 months in aggregate, that's where we're at, 103%. And it's going to get worse because you're still repricing interest from the Fed's rate hikes. And it's going to get worse because there's still boomers aging and healthcare is getting more expensive, not less. With a caveat. The release valve is the dollar. And that is to say inflation, because inflation will drive nominal receipts up. So if we get a new spate of inflation, a new spate of dollar weakness, the $2 trillion deficit that we just had to end last year will be much smaller deficit if the dollar falls enough. So DXY on the dollar, we'll just use that, is call it 106 today. We ran a $2 trillion deficit last year. If it's at 110, we're probably going to run a $2.5 or $3 trillion deficit. If it goes to 90, we'll probably run an $800 billion trillion deficit. If it goes to 65, we might run a surplus. And so that is when you say, where are we in innings for the U.S., like the way you get to extra innings, the way you keep the game going is you're going to have to let the dollar go. You're going to have to inject dollar liquidity. Right. And critically, where we are in the game, where we are 103% of receipts just for the interest and interest-like obligations, paradoxically, that's going to force the dollar up in the short run until we print enough to get it down, basically. And so it again leads to this very binary,
Yes.
you know, dollar up, dollar up, dollar up. Then once things break, they're not going to break like that. They're going to break like that. You're going to see what we saw, you know, if you liked your 70 basis point increase in the 10-year treasury yield in 3 or 4 weeks, you know, you would love how fast the 10-year would rise if the DXY went to 114. It would be 70 basis points in a week. And if it went to 120, it would be 70 basis points in a, maybe 122. If it went to 130, it would be 70 basis points maybe in a day. Like I'm being hyperbolic to a certain extent.
Yeah, sure.
But, you know.
But it sounds like treasuries could start acting more like shit coins.
Arguably, they already have been, really.
Yeah.
You know, and again, and that maybe is a great way of framing like what is like the real end game in sort of when you talk about it. Okay, if that gets us, if moving the dollar gets us to extra innings, the game still has to end in theory.
Yeah.
The structure of the system, the indebtedness of the system means that the weaker the dollar is, the lower the deficit is. And therefore, there'll be more buyers, paradoxically. You wouldn't think this, but you would, but there'll be more buyers for the less issuance. So yields will be relatively well behaved. But the dollar going to these levels means inflation is going to pick up on a lag. And so there is a dollar level, right? What we're talking about is the higher the debt goes, the lower the level of dollar that we can afford where the treasury market doesn't break, where the yields don't just, we lose the long end. And that was 114 in the third quarter of 22, and it was 107 in the third quarter of 23, and it's right around 106 now, maybe even a little lower. Let's use 106. So that number's going down, which makes sense. As your debt goes up, your sensitivity to too much debt goes down, right, in terms of the currency. The flip side is the price of the dollar that you need, or the level of, let me put it this way, the level of rate that you can afford keeps going down too with the higher debt. But the level of inflation with the weaker dollar so that you can afford the debt will be going up. And so you've got a pincher movement, weaker dollar, the level of dollar weakness to drive too much inflation keeps going up because the debt keeps going up. And the level of dollar that creates treasury dysfunction because of too much debt and not enough balance sheet keeps coming down. Whenever those two things get too close together and meet, that's the end of the game. That's where you get, you know, things will get weird.
If you enjoyed this clip, click here for the full episode and here for more just like it. Also, like this video to help shine light on the corruption of money and subscribe to stay connected. Thank you.